We're here to talk about Silicon Valley real estate market ending the week of February 21st. These are the key chapters we're going to be going over, and let me know if you have any questions as we go through. Here's the first data slide. This is some key information on this slide, in my opinion. Look at inventory. Inventory was very limited just 7 weeks ago, and it's been growing. What you have here is the gray line is your typical line. That's based on the previous 10 years. The blue line is the most inventory you'd expect based on those 10 years, and the red line is the least inventory you'd expect. And it's not the magnitude of the inventory or anything else that's important, but what's important is the fact that you went from the least amount of inventory you expected to the typical amount of inventory you expected basically from 7 to 3 weeks ago. And now you're rapidly approaching the most inventory you'd expect. So inventory is growing very rapidly at this time of the year. In terms of percentage, we went from 13% below the median inventory expected back here when it was up off the red line. So here 7 weeks ago was actually lower. It was probably about 80% of the inventory you'd expect. And now we're at 111%. Also new, I think this week, this is the current week right here where it says this. This is going out in the future. And obviously I don't have the purple line, the data line for future, but you have the trend line, so you can see which direction the line's going. And so inventory is going to continue to increase for the foreseeable future for most likely the next 12 weeks. You can see week 13 is essentially flat. But the critical point again is whether the inventory actually grows greater than it typically does, which is what it's been doing recently in the last 7 weeks. Now looking over and looking at offers, doing the same concept, notice you were down here with the least number of offers you would expect. And you were actually a little bit 7 weeks ago, you were actually slightly below the blue line, so less offers than you expect. So the number of offers have come up. But now if you pay attention to just this past week, notice how, in my opinion, the vertical separation here is a little bit greater than here. So even though the number of offers increased from last week to this week, as it typically does at this time of the year, the rate of that growth appears to be a little bit less, although you have come up from 78% of the offers you expected 13 weeks ago, a quarter ago, to 88%. So you've gained basically 10% of the offers, which is a good thing. But meanwhile, your inventory has gained something approaching 24 or 25%. So your inventory is gaining a larger percentage than your offers. And if we were in an inventory limited marketplace, like a lot of people claim we are, then your offers accepted would have kept up with the inventory growth. So I don't think we've been in an offer limited marketplace, and I think it's concerning that the offers aren't even keeping up with the inventory growth. Let's look at days unsold inventory. This is a seller-buyer balance, supply-demand balance in economic terms. And here you can see you're between the gray line and the blue line. You're closer to the blue line, so you're a slower marketplace than you typically would expect, and we're currently 11% slower. Now, keep in mind, and this is something you have to remember here in Silicon Valley, we have a very interesting marketplace where it's always on fire. So even though it's slower than normal, you're still going to sell out your entire inventory in just over 5 weeks, 37 days. That's a month. You know, you listen to people across the nation and they talk about 3 to 7 months being normal inventory. Here we're talking about 1 month of inventory, and we're talking about that being more than it typically is. So the marketplace, the turnover rate is still fast paced, even though it's slower than it normally is. Moving down to days on market. Days on market place to me is a good key indicator, but almost everybody follows the median or average days on market. Now, the problem with both of those is if you're looking at average, you have one person that sells their property after being on the market for 2 years, it pulls up the average. And the problem with the median is most of the sellers are not look at an offer immediately. And so almost half the properties sell as soon as that seller is willing to look at an offer. So the median is too stable of an index. So I sort of hedge the bet and look at the third quadrant, the 75th percentile. How long is it taking 3 out of 4 sellers to sell their property? And the concept here is the same. But notice how we were going from longer than marketing time, then less than marketing time. And this is the market that's absolutely on fire. But notice how we're basically now level for the last 2 weeks. And what do I think this is really saying? I think this is saying that the number of buyers out there is less than the number of sellers coming on the marketplace. So the buyers that are getting their offers accepted, which is the only part of the marketplace that's in here, is getting satisfied by the new listings. They're not having to go back and look at last week's listings that were picked over to find a property that works for them. And therefore, this is faster than normal because there aren't buyers that weren't satisfied with the current week's inventory that are buying the properties that are on the marketplace. Now, moving down to some ask price reductions, this is, in my opinion, very telling. Just 3 weeks ago, we had far less price reductions than normal. But now we've already crossed over the normal line, and we're now having more than the normal number of price reductions. And this is magnitude, and this is everybody. And that's why the numbers are so small. Yes, the number is very small. We're only talking about 0.5% of a price reduction, but that's still almost 20% more of a price reduction than typical. At this time of the year, all the listings coming on the market are new on the marketplace. And so to be having more than the number of price reductions, the sellers are already giving up on the marketplace and are reducing their price at a larger than normal marketplace. So unfortunately, from what I am reading on the overall data, even though the market is still fast paced because we're only looking at 37 days, I think we're seeing indications of the market slowing. I think we're seeing inventory growing more rapidly. We're seeing offers not keeping up with that and still being below normal, even though inventory is above normal. So inventory is above normal, offers are below normal. And then you're seeing increasing number of price reductions early in the year at a time when, if you look at the gray line, it's normally getting less and less price reductions. You're getting closer to your zero axis. And if you look at the purple line, the actual data line, that's not only horizontal, that is increasing price reductions slightly. So it's the opposite trend of what you'd expect. And then you go on to the last indicator, which is overbidding, and you go, well, Richard, look at the amount of overbidding and it's rapidly increasing. Yes, it is. But remember, overbids is a lagging indicator because we need the escrows to close. And so although overbidding is currently at 6.8%, those were transactions that were created 5 weeks ago, more or less. So they were very early in January, mid-January transactions. And what these other indicators are what the market is currently doing. So I think what we're going to do is see the amount of overbidding go down. And overbidding is also not necessarily that important in a lot of ways either, because if all the sellers adopt the policy of pricing their home below where the market actually is to attract a lot of buyers to get multiple offers in, then you're going to have overbidding even in a declining marketplace. Here now we're looking at going all the way back to January 1st, 2015. The first 9 years were on what I call the condensed scale. You can see from this vertical line back to that vertical line is 1 year. Each of the finer lines in between are quarters. But then for 2024, I expand out the x-axis. So a year goes all the way from this line here over to here, and each quarter is here. So it's roughly 2 times the horizontal spacing for the recent year. What are we looking at? We're looking at inventory here in the purple line, and this is a percentage normal. So basically at the first of the year, we were only at 73% of normal. Now we've skyrocketed and we're at 112% of normal. So you've gained, 41% of your marketplace in just 7 weeks, 8 weeks. And meanwhile, your offers have been increasing, but not nearly as much. And again, notice here's the decrease that I was talking about. You went from 90% of your market offers accepted to 88%. So you lost 2% of the marketplace as far as offers at a time when inventory was increasing. Your days unsold inventory is still coming down. So your days unsold inventory, the speed of the market is still improving, but it's slower than it typically is. Typically, typical would be 100% right on this black gray line here. And you can see you're getting closer to it on the days unsold inventory, but it's still a slower than normal marketplace. So again, to me, this is all caution to the pay attention what the market's really doing. Now what we're doing is we're looking at each component. We're looking at inventory all the way back to 2015, January 1st, Again, you have the expanded scale in 2024. You can see that you went from the least amount of inventory you'd expect to the typical, and now you're slightly above, and it's the vertical separation here that you're paying attention to. So your inventory is growing more rapidly than normal. Here it is on a percentage basis, and you can see it just going right up, and you're somewhere, what was it, 11%, 111% of what it typically is. Offers accepted. So now here's your offers accepted line, and you can see you were basically right on the blue line, and you pulled up, and it looks like you're tracing the gray line, but I think on the next graph, we will see that we actually pulled down a little bit in this last week. And here's the reversal, and there's the little pull down that I was talking about. So you were improving, you were going from 70% of the offers you'd expect up to 90%, and then we went from 90% down to 88%. Looking at days unsold inventory, so your speed of the marketplace, it's pretty close to normal, but notice this almost horizontal data point here. And I also need to point out that last week was a holiday, but when you're comparing it to the same dates of the year, your holidays should more or less line up with one another. And in fact, while we're talking about dates, remember this February 21st data. I use a March 1st calendar year. And so next week, instead of looking forward 7 days, I'm going to have to jump forward 8 days to get back to that March 1st. I believe there's an annual cycle and a huge weekly cycle. So I need to put the same weeks together. We also have a discontinuity because we have 1 extra day of the year normally, and leap years, we have 2 extra days. So I put that together with the February leap year, and that's why I have a March 1st fiscal year for the real estate calendar year. Here you can see the market was improving, and then it turned around and went up just ever so slightly this last week. And next week will be real telling because there was a fair amount of inventory growth this week. Here's your days on market. Now, a couple things are noteworthy here that I've pointed out before. That's following the pattern of the gray line, but it's moved back several weeks, which I really don't understand. And even here, it's going horizontal, which you sort of expected it to do, but it's doing it at least 2 weeks earlier, if not 3 weeks earlier than it typically does. 1 week, it looks like 2 weeks, because next week is probably going to be right there, and then 2 weeks from now it's going to be right here. So for whatever reason, we have an offset of 2 weeks. And it's not my data, at least I'm pretty confident it's not my data, because if you look back, these peaks are they're going to be similar, or they're going to be the same, and they line up with the purple. It's only this year, and the purple peaked before the end of the year. And I don't know the significance of that, but it's interesting. And here you can see the huge rundown, and you can see that we turned around and we're now going the other direction. So we are in a very fast pace. We have some of the record low. You can see the only time we were faster than this was right before the 2022 turndown, which I believe happened right around February the 14th. So are we matching this where we're going to have a February 14th of 2025 slowdown? Only time will tell. Here's looking at the sellers that are taking the largest price reductions. I believe that there's so many sellers that don't do price reductions that the average is really not telling. The median is pointless because that's going to be 0. And so here, and instead of looking at the quadrants that a lot of statistics use, I'm actually just looking at the 90 percentile. The 10% of the sellers that are taking the largest price reductions, how much are they taking? And you can see that right here, they're somewhere around 91%, which means they're asking 91% of what their original ask price was at the time that they got the offer accepted, or they've taken a 9% price reduction. And you can see that number is actually going down, and it's right about typical. It was less than typical, and now it's slightly more than typical. Here you can see it on a percentage basis. So here's where you were less than normal, and now this week you're above normal. So they're small numbers, but percentage-wise, we're back up here, in the heat of the new year's over with, and that should be adjusted anyway because the new year comes at the same time every year, and that would plot out at 100%. Here's the average price reductions. I do this just so that people know that I'm not trying to play games, which is pretty easy to do when you manipulate a lot of numbers. You can see the purple line has gone down, but it's very close to the normal line. But what's noteworthy is the downward trajectory of the purple line, which is going towards a cooler marketplace, is the blue here, at a time when it's normally heating up. So not only is it, the magnitude may be small, but it's the wrong direction. So that's very noteworthy. Here you're seeing the same thing where you pull out that gray normal line and do it on a percentage basis. So you're doing less price reductions than normal. Now you're taking more price reductions than normal. Yes, it's very close to normal, but it's still less than normal. Here's the frequency of price reductions. And again, you can see you were on the hot side of the number of sellers that were doing price reductions. But again, this last week, so early in the year, we were already starting to see an increase. Now, granted, the numbers are small, but again, it's at a time when the market's normally taking less and less price reductions. The actual data this year, we took slightly more price reductions. Here it is on a percentage basis, and you can see we went from something like 77% to about 83% in price reductions. So the frequency of price reductions is becoming more frequent. And here's that frequency based on percentage of normal, and you can see it's increasing. And then moving over to overbidding. This again is a lagging indicator, and it's skyrocketing to a hot marketplace. But again, it's the lagging indicator. This is what was happening 5 weeks ago and not reflective of what's happening in the marketplace right now, this week, last week. So this is what you would call a lagging indicator. It takes time to get the information to plot the data. And one of the reasons I do the data so frequently is to get rid of some of that lagging indicators and to better understand what the market's doing right now today. Here you can see the big percentage compared to normal, and that's actually going towards a hot marketplace. But again, this is a lagging indicator. It will be interesting to see what this data reveals in another 5 weeks after it was reflecting of what the other market conditions that we're seeing right now are showing. Here's the frequency of overbidding. So how common is it? It's a little bit more common than it typically is. And it's the vertical separation. The horizontal is pretty small, but it's maybe 2 weeks, but it's the vertical separation. So maybe it's normally 60% of the sellers are getting overbids, and right now you're at about 66%, so about 10% higher. And I think the actual number was 11% higher, if I'm remembering correctly. And here it is, basically right at 11% more sellers getting overbid than typical, and it's increasing. I would almost expect on the data now, in 5 weeks, this number is going to be going the other direction. And when it turns, who knows? Here's your long-term pricing thing. We've seen a significant increase in pricing, which is a positive thing, obviously. But again, in order to get the sale price, escrows have to close, and that's a lagging indicator again. So this is a reflection of where the market was 5 weeks ago, not currently. Here's your monthly payments. I'm assuming an 80% loan using the national average for high balance conforming loans, which is higher than you would get for jumbo loans, but it's a way to compare the different payments. So now what you can do is you can compare the payments now to where the payments were, say, in 2022. So they're only slightly higher than they were when the market slowed down in early 2022. Now we're looking at distributions. We're starting off a year ago on the dotted line. You can see it right through here, and that's where we were a year ago. The purple line is the current data. So you can see the current data is on the red side of the dotted line. So you're a hotter marketplace than you typically are. And we'll step through the first quarter or dotted lines. And I start off with every week for the first quarter. Then we go for 2 quarters on the dashed lines where I'm going every other week. And then we finish up with a quarter of weekly data at the end. So there you can see the market's going to get hotter. There's sort of the peak of the market right around March 29th through April 26th. Then it's slowing down fairly significantly. And then we sort of get to a stable part right through here where it really doesn't move very much one way or the other. And this is days on marketplace. And here you can see this increasing time on the marketplace. There's sort of the longest on January the 3rd. And then you can see you're rapidly decreasing the time, and there's current data. So we're currently at the bottom of the marketplace. Thing that you would expect is you expect the data to improve a little bit more going forward based on based on last year's pattern, because that's the only data that we have on here. Because you can see the dotted lines were lower down. Time will tell at some point. I think this is going to reverse, and this may be the lowest that we're going to see for this year, and we may turn around and start going up earlier than we normally do. Here's we're now looking at the largest price reductions, and I don't have the 10% up here because I've dropped off the very largest 2.5%, and that's to try to get more stable data. and I go all the way down to 17.5%. So I'm looking at 15% of the marketplace offset by 2.5%. So I'm ignoring the sellers that are taking the extremes, because sometimes that's data error or just a weird situation. So you get that out of the data and then you plot it. And otherwise, the concept's the same. The dotted lines go for the first quarter, the solid lines are the most recent quarter, and the dashed lines are the 2 quarters in between. So you can see you're going up, you're getting hotter for a while. Right around there was the peak of the marketplace. Then you go back and bounce back up. So there is some bounce every year, which you'd expect. And now you can sort of see you're in the summer doldrums where there's really not much change. It's going one direction, but now it's going to start going the other direction. And now you're going to get in the slowdown at the end of the year. Right about there is the peak, which was about December 20th, if I read it right, which is the most price reductions. And here's back to current. So you're basically on both sides. Remember, the dotted line is last year. So at the very high end, we're taking bigger price reductions this year than we did last year. But for a lot of the data through here, you're actually taking more price reductions last year than you did this year. So when those two balance out like that, I would say basically you're taking roughly the same amount, same price reductions as we did a year ago. There's the buyer overbidding competition, same concept. You can see that the market pretty much goes up. Right about here is the peak of the marketplace, right around the end of April, beginning of May. And again, that's the lagging indicator, and you can see it slows down. And now you're going to bounce around for August and September and October. And now we're getting into November, so now you expect it to march down pretty rapidly. And then we're going to get into the bottom of the year. January 31st was sort of the bottom of the year, and then you're going to start improving. So that sort of gives you the distribution. So you can come here and see that 65% of the sellers are getting more than their asking price. Roughly 10% of the sellers, from 65 to 75% of the sellers, are getting exactly their ask price as you're at 100%. And then 25% of the sellers are getting less than their asking price. And you can see where it falls off. Almost all the sellers are getting within 10% of their ask price. It's just there's two things. Sellers are hesitant to take a large price reduction at their offer. Buyers are also hesitant to offer significantly below the ask price. So what ends up happening is the property sits there until the seller gets close to the market value before the house has a chance of really selling. Here now, as we're looking at the 3 counties, we're looking at San Mateo County in the orange, blue is Santa Clara County, and the gray is Alameda County. So we're going back to that January 1st, 2015, 9 years on the condensed scale, and the last year and a half, or the last year and the current year on the expanded scale. You can see inventory in all 3 counties is going up. You can see inventory in Alameda County is significantly higher than it is in Santa Clara County, even though it's typically at the same level. Here's the offers accepted. So now Santa Clara and Alameda County are right on top of one another, to the point where you can hardly see Alameda County. If you come down here right at the bottom of the V, you can see the data line is still there. So that indicates that Santa Clara County is going to be a faster paced market than Alameda County, because Alameda County has more inventory and is selling the same number of houses. In San Mateo County, you can't make that analysis just off the top because the inventory is so much different. And here you can see that Santa Clara County, in fact, does have the fastest marketing time with only 30 days of unsold inventory. San Mateo County is second at 38. And the slowest county is Alameda County, but by slowest, it's still 45 days. That's only a month and a half. And in most areas of the country, would be very pleased with being able to sell their entire inventory in 45 days. Here's the marketing time, much closer together. But again, Santa Clara County is the fastest at 11 days. San Mateo County comes in second at about 15 days, and Alameda County went from 15 to 16 days, so it's already increased by 1 day for the marketing time in Alameda County. Price reductions, so far, you got 2 of the areas that have rolled over. So Santa Clara County is already taking larger price reductions. They went from basically 99.9% or 0.1% price reduction to a quarter, and show that they were taking larger price reductions. But you can see the lines going down. Same thing with San Mateo County. Alameda County actually came back up, so it's basically flat for the last couple of weeks. Here's the frequency of those price reductions. Santa Clara County has the least frequent price reductions with just 6%. It's basically did a little bit turn. San Mateo County did a turn the week before, but was flat this week. Alameda County came down the week before and is just flat this week. So clearly things are happening with price adjustments. They're starting to be flat to increasing. Here's the overbidding, and again, this is a lagging indicator, but all three of these counties are going up, in which would be indicating more buyers are feeling more competitive marketplace. And again, this is where the market was 5 weeks ago, because that's how long it takes to get the data. Here's the frequency becoming more common, and the most common in Santa Clara County at over 70%. The other two counties are over 60% of the sellers getting more than their asking price. Here's the long-term appreciation. Santa Clara County has the highest appreciation rate at almost 100% appreciation. It's doubled in price since the last 9 months of 2015. Alameda County and San Mateo County are exactly equal or very close to equal here at something like 66, 67% appreciation. Here's the pricing. I will point out that San Mateo County is back on top. I looked up the number. I think it was 13,000 higher than Santa Clara County. Santa Clara County has reversed direction and went down in price this last week. You can see the peak was up here. And now if you look real carefully next to my red dot, you can see it on poking out a little bit on the right side below the peak of the orange. And for San Mateo County, and as I indicated, it's about 13,000 lower. Alameda County went up quite a bit last week. Same information on regular paper. And again, you can see the blue line is down here and the orange line is getting hidden. The orange line is above the blue in Alameda County. I don't go all the way out to the data point, so it's easier to see where the actual data is. Here's the estimated payments. They're going to be in the same order since they all go through the same formula. Here are my heat maps. This is showing you the area. You can see that it's a faint shade of blue overall. There is a little bit of pink, which would be a hotter marketplace. This is just, inventory levels. Pink marketplace would indicate less inventory than normal. And you can see that's around 72, 81%. Even Saratoga Las Gatas at 86%. But then you also have areas in San Mateo County where you have 40% more inventory on the bay side of the hill. And the coast is actually just perfectly normal right now, which is why it's no color. Here now is the number of offers. So the coast I pointed out had normal inventory, but look at the offers. It's having almost no offers. Only 45% of the offers that you'd expect to have on the coast. Pacifica area of San Mateo County is only at 70%. And again, you can sort of see there's a faint shade of blue, which means we're having less offers than normal. You can see that Silicon Valley's only got 90% of the normal offers. Santa Clara County is at 88%. San Mateo County is at 93%, so it's actually doing better than Santa Clara, and Alameda County is at 90%. So in this particular metric, as far as offers accepted compared to normal, Santa Clara County is doing the worst at only 88% of where you'd expect to be. Gets any lower and it will start being more blue on there. Here's your speed of the marketplace, and again, this is compared to the 10-year median. So the market is slower, as you can see, with the blue, and the blue in most areas. Sunnyvale and Cupertino is quite a bit pinker, so less than normal. And what would the number be? Cupertino 71%, Campbell at 83%. Everybody else is over 100. Atherton's at 90%. But you can see Silicon Valley is at 12% above. Santa Clara County is right at normal. San Mateo County is 20% slower than normal. And Alameda County is 13% slower than normal. Here's actual, just raw numbers, so no longer comparing to normal, just the speed of the marketplace. So even though I'm maybe a little pessimistic, it's still a fast-paced marketplace. I mean, most of these areas, 37 days to sell out your inventory for Silicon Valley, 30 days in Santa Clara County, jumping down 40 days in San Mateo County, and Alameda County is 44 days. So that's still a fast-paced market, which is why you have a fair amount of pink, but it's slower than it typically is. That's the difference. Here's days on marketplace. Can't be redder than that. A lot of it's saturated. I mean, you're selling 75% of your inventory in 8 days. 3 out of 4 sellers are selling in a week. It's hard to explain that even though there's indications that the market's slowing down, Silicon Valley is so fast paced when you look at the pace of the marketplace, it still would tend to favor the seller. Here's ask price adjustments. It's still fairly pink, meaning low price reductions. San Mateo County is clearly a lot more neutral with no coloring and a little hint of blue in the coastal area there with a 1.5% price adjustments. Now, this is the frequency of price reductions, and except for the coast, the rest of the valley pretty much is red in color. So again, sellers are not taking large price reductions by any stretch of the imagination, or aren't taking it frequently. You know, in Cupertino, 0% of the sellers are doing price adjustments. 5% or 6% call it in Milpitas. You know, these numbers are very small, but they're typically very small. Here's your overbidding. Overbidding is not happening in the coast area. In fact, they're going down 5.5%, which is pretty significant. You can see some of the areas in the central part of Silicon Valley are pretty red. And again, this is lagging behind because you need the close data in order to know how much the buyer overbid. Here's the frequency of overbidding. So again, except for the coast, overbidding is very common. And again, that would be about 5 weeks ago. Here's the appreciation. So here you can see the areas that have done the best since the last 9 months of 2015, and then the areas that have done the least well. Basically, from the way I read this, is it's the more affordable areas that are still relatively close to the workplace that have done best. Areas that were extremely close to the workplace have done poorly because more people are working remotely or not going to work as often. Here's your sold price, and instead of following the median number only, which is the middle number, I sandwich it out with the cheapest 10 percentile on the left and the most expensive 90 percentile on the right. So you know a price range in each one of the different micro market areas. Here, blue is the more affordable areas, red are the more expensive areas. Here's a summary. You can start off on the geographical area on the left, read across in your micro conditions, or start off on the right with either the payment or the price. The lagging indicators are shown in orange. The real important indicators are in the brighter highlighted area, and the less significant leading indicators are in the lighter shade of yellow highlight. Here are the actual raw numbers for people to pay attention to. You can see new inventory grew by 8%, 7.7% overall. Offers or active listings went up 9%, and offers went up 9%. So the offers and new inventory are roughly in balance, but the new offers are not eating up all the inventory. The speed of the marketplace is still reasonable and still decreasing, which is a faster paced marketplace. Today's numbers, this week's numbers in the highlighted yellow are lower than last week's, which would be a faster paced marketplace. Here's your median days on marketplace, and you can pick out whatever number you're interested in. Here's a summary of the number of offers. And just last week, I think I said that I didn't think these numbers here would catch up. I now do. You're only 15 away. We may catch up next week, and we may have the slowest out of the last 25 years again. We're only 50 away from 2 weeks ago at 1270. So I think these two will definitely catch up, and will then end up with 6 weeks in a row with the least amount of offers accepted in the past 25 years. The reason these numbers are going down is as the transactions fall apart, that decreases the number of offers, the successful offers that were accepted. And that's what I do is I look at offers accepted, but then I subtract off as the escrows go when I update it for a quarter. So it's updated for long enough that most of the escrows have closed after 13 weeks. With that, we've been talking about the Silicon Valley real estate marketplace. We will be talking about the Greater Bay Area in 5 regions, 13 counties. Here is the YouTube link where you type out the blue thing and you get to the channel where I have the archive, so you can back and listen. That keeps me honest. Or you can type in the green root URL that takes you to the same place. It's less typing. If you type in the green root URL plus 2025, Saturday mornings at 9 a.m., you get to the live presentation, and then you can interrupt and ask questions. If you want a handout, there's a 67-page PowerPoint presentation, PDF, that you can download and look at. Any past episode, you just type in the green root URL, the year, month, date code that you're looking for. I'm Richard Calhoun, real estate broker with Creekside Realty, and there's my contact information. I work with either buyers or sellers here in Silicon Valley. Happy to discuss your real estate wants or needs. And let's see if I have any questions. I'm not seeing any unmuted mic, and I'll get into that 13 Bay Area. Moving on to the Greater Bay Area, it's made up of 5 regions, the first being Silicon Valley that we've already discussed at length. Then the cities, San Francisco and Marin, North Bay, Central Valley, and the Central Coast. Here you're looking at the inventory. You can see that inventory is going up clearly in 3 of the larger regions. You might argue that in the cities it's getting close to flat, and it's definitely flat in the Central Coast. But inventory is basically on the increase in the greater area. Here's the days of unsold inventory. So supply demand balance, how quickly you're turning over, clearly going down in all 5 regions. Silicon Valley looks like it's about ready to go completely flat. It looks like it's down just a little bit this week. Here's your marketing time. 75% of the sellers down in most of the areas, 3 out of 5 areas, flat for Silicon Valley, and actually increasing fairly significantly in the Central Coast. Greater area of price reductions. This is how much the sellers are reducing their own price. Definitely a mixed bag here, with Silicon Valley reaching out about probably 3 weeks ago with sort of the least price reductions. Sellers are starting to take more price reductions in Silicon Valley, bouncing in the cities, going up, less price reductions a little bit this week from last week, but definitely bouncing. Central Valley is still decreasing but leveling off. North Bay is bouncing around, and the Central Coast is actually increasing price reductions this last week. This is the frequency of price reductions, so how common are price reductions? Basically down in 3 out of 5 regions, flat to up a little bit in Silicon Valley, so more frequent for sellers to do price reductions in Silicon Valley, and up fairly significantly in the Central Coast, up by 2 whole percentage. We're going from 30 to 32% of the sellers are reducing their price. This is the overbidding magnitude. Now this number is lagging behind. So overbidding is down in the Central Coast. So that means the buyers are feeling less pressure in Monterey and Santa Cruz, basically increasing but fairly flat in the Central Valley, flat in the North Bay, still increasing fairly dramatically in Silicon Valley in the city. So that means the buyers are clearly feeling the pressure to make their offers competitive. And again, this would be lagging indicator because you don't know what that sale price is until escrows close. This is the frequency of overbidding. Increasing number of buyers are overbidding in all 5 regions. So that means in regions like, I think it was the Central Coast, Central Coast, where the magnitude is decreasing, but the frequency is increasing, that means the magnitude is really going down because there's more overbidding going on, but yet the average overbid is less. So that means the magnitude of overbidding is decreasing more than the previous chart would indicate. It's going up in all of the regions, as I said, up significantly in both the cities and in Silicon Valley. This is the long-term appreciation, and as I've been saying for a long time, the cities is clearly the hardest hit since the pandemic. The area that has the highest appreciation is Central Valley, followed by Silicon Valley, followed by the Central Coast. And in 4th place is North Bay. All of these are increasing, which means prices are going up since the benchmark is the last 9 months of 2015. So that number's fixed. So when your rate of appreciation is going up, that means current prices are going up. Here's the sold prices. And as I said, all the prices are going up in all the different regions, the least going up in the North Bay and the Central Valley, going up fairly significantly in the cities and in Silicon Valley. This is the estimated payments in the same order and the same increase because the formula is the same and the interest rates are fairly stable. They went down by, I think, 0.02% again this past week. Here are the numbers. Here, not only do you have the raw number in the now column for each of the 13 counties, but you have the increase or decrease from a week ago and the increase or decrease from 5 weeks ago. So you can see that the magnitude of the increase is decreasing in most areas for active listings. Offers, it's 50% increase from last week. So the offers increased is greater last week than the 5 weeks ago. And that goes all the way across. The appreciation is a relative number to a point in time, so I don't compare that to this week or last week or 5 weeks back. And with that, we're finished with the presentation and happy to answer any questions anybody might have. Not seeing any unmuted mics. Have a great week. Take care. Bye for now.